Hello and welcome to a brand new show, CIO Calculus. When we started the year, the conventional wisdom was emerging market equities will outperform developed market equities, bonds will underperform commodities, and gold will be considered as a safe haven. But 3 months into this year, pretty much the reverse script has played out. Commodities have seen a big fall, emerging market equities are languishing, and US equities are sitting at a new record high. So what's in store for global equities and Indian equities for 2013 and beyond? Let's understand that with some of the top global money managers. For the first time on Indian television, we have the key members of Team Pramerica with us. Starting with my extreme right, I've got Glenn Baptist. He's Chief Investment Officer, International Business with Pramerica USA. Kenichi Shukaguchi, Chief Investment Officer, Japanese Equities with Pramerica Japan. And to give us a flavor of emerging market and what is happening in markets like Brazil, I've got Alexander Meai, Partner and Chief Economist and expert on Brazilian equities. Glenn, let me kickstart the discussion with you. If I look at the current environment, fear clearly is no longer occupying center stage and growth seems to be coming back. But along with growth, complacency also has made a comeback. So how would you characterize the big global picture for us?
My own personal view is that I don't think we are at a complacent stage yet. There may be some sectors in the market, some asset classes where maybe we are getting a bit too complacent, and we can talk about that. But generally speaking, I think there's a reason why investors are putting on a risk-on trade. And the basic fundamental reason that we see is the wall of liquidity that's being pumped into the system by all the central banks in the world. And most recently, we've seen that with the Bank of Japan. So I don't personally see investors getting complacent. I think they're still looking for opportunities around the world. The only place where maybe some complacency is beginning to set in could be the corporate bond market.
Just to have a follow-up question here, are you a bit surprised with the strength in developed market equities? Dow is at a new all-time high. S&P is marching from strength to strength, and Nasdaq is at a fresh 11-year high.
Well, one should always say that you're always surprised with outcomes of markets. I think if you roll back the clock a year, going into 2012, everybody was very pessimistic, and markets turned out to do quite well last year. This year, everyone became very optimistic about the emerging markets because some of them had underperformed, but unfortunately, they continue to underperform this year. I think the developed market story this year has been largely driven by what the Bank of Japan has done. That has provided a fresh boost, really, in terms of where markets are going. And I think that will likely continue for the near term.
Kenji, the big story is the strength in Japanese equities. Who would have thought at the beginning of the year Japan would be sitting at a fresh 8-year high? Do you think weakness in the yen is the real story and that is the only reason why Japanese equities are outperforming?
Yes, I think definitely the weakening yen is the biggest, driver of this very strong equity market in Japan. But I think, the Japanese equity market very undervalued. And that's a reason of, so this is a kind of normalization process in terms of valuation.
What do you make of the BOJ action? The BOJ clearly is committed to print more money, which means yen in the near term will remain weak against the dollar.
Yes. I think already we saw the strong depreciation of the yen, but most parts realized just before the BOJ's decision. And now the BOJ supplies the market again and exceeded the market expectation. In that sense, we see much more, depreciation of the yen going forward.
The big fall in commodities, how will that change life for a market like Brazil, which is directly, indirectly dependent on global growth, global demand, and global commodities?
Yeah, one can say that the global cyclical stocks, they have traded at very cheap valuations for the last 2-3 years. So it should not be that much of a surprise to see iron ore prices and copper prices and even oil prices falling. So those sectors have underperformed the markets, and they should continue to do so, given that global demand is running at a much more moderate pace, and there is supply coming into the market, not only on the oil market but also iron ore market. So this change in the global economy is certainly positive for India economy and not that positive for Brazil. That's why we grew at 4% before, and now we are growing at 2, maybe 3% this year.
So do you think the best of the brick is now behind us and the brick has clearly hit some kind of a wall?
I think you have to go case by case. I mean, if we have iron ore prices and oil prices falling, maybe things will get tougher for Brazil and not that tough for India. So you have to go case by case. Our economies, and our economies, they all have different struggles to solve, structural and cyclical problems. But I'd say that the good old days, probably as they were, are over. But we still have a very long-term road to drive, and things will certainly improve in the medium term.
Glenn, is that the big story, that the brick has hit some kind of a wall and the golden period for Brazil, Russia, India, China is behind us?
I wouldn't say so at all. I would call it a bump in the road as opposed to hitting a wall. I think what you're seeing with the BRICS is basically a cyclical slowdown, not a structural change. The structural story is very intact. The BRICS and frankly other emerging market countries have captured the imagination of global investors, US investors, European investors, certainly Japanese investors as well. Money will flow to all these markets. What you're seeing is the slowdown because of interest rate hikes that occurred a year to 18 months ago. That's a natural cyclical change that's happening. In the case of China, it's a desired outcome that they're looking for in terms of slowing the economy to a measured pace of growth as opposed to a breakneck speed. I think that's a very smart outcome that they are looking at. I think India too is facing a cyclical slowdown because of interest rate hikes and other issues, maybe with the current account deficit. So certainly don't feel that it is a case of the bricks hitting the wall. It's much more just a bump in the road, which they will certainly recover. And as Alex pointed out, the long-term story is very much there.
What about global liquidity? Is there a fear that in the second half of this calendar year, US Fed may be tempted to pull the QE3 plug out because the street clearly is divided on what the Fed could do next?
That's always a risk. We don't think it's the most likely outcome at this point in time. Economic growth in the first quarter will be strong, but we are going to see a slowdown, more of a give back, if you will, in the second quarter. More trend pace of 2-2.5% in the third and fourth quarter. We don't think that that's enough for the Fed to be convinced that the economy is on a sustainable footing. We think unemployment will take its time to come down. So we are not calling for the QE to end by the end of this year. This is probably more of a story for next year, though. I think the market will begin to predict and get fearful of when the Fed is going to stop putting money in and potentially even beginning to pull out. We don't think it pulls out. We think the likelihood is that the Fed will stop the QE program probably sometime in early 2014, but we don't think the markets will begin to worry about it until we get closer to that.
So give me a broader assessment of your current allocation. Are you leaning towards developed markets? Are you leaning towards Japan? Or are you leaning towards emerging markets?
Well, we have a global strategist who does advise on certain portfolios. This is certainly not the way Prudential manages its own money, because as you know, we are an insurance company and most of our money is in US fixed income. But from our global strategist point of view, really what we have done is overweighted the developed markets at this point in time. Frankly, we've put a lot of money into Japan because we too feel that the momentum that has been driven recently by Abenomics in Japan will continue. We don't know if it's going to be sustainable or not, but for the near term, 6-month horizon, 12-month horizon, we feel that that's the place to be. We are also interested in markets like Eurozone. We're not sure yet whether the opportunity is right. Valuations are incredibly cheap, but we still need some structural reforms there. So if you look broadly speaking, at our global strategists' portfolio recommendations, the biggest overweight would be in Japan.
Kenji, how confident are you of the recovery in the Japanese economy? Because if I map the data, for the first time in many years, or I would say many decades, Japanese equities have got inflows. Do you think this is just a flash in the pan, or Japanese equities now could be net recipient of global liquidity?
I think I'm not so confident on the sustainability of the economy or equity market because, for example, we expect the Japanese economy to grow very strongly this year, but next year, if we look at the next year, we expect the consumption tax hike in April next year. And also this year's economy is boosted by the supplementary budget announced in January. But after the consumption tax hike, we expect the economy will decline pretty sharply because of the backlash from those kind of measures.
If I look at the decade gone by, between 2000 to 2010, all emerging markets, courtesy global liquidity, they moved in a synchronized manner. But now do you think we could be staring at a different performance within the emerging market basket? So China could be going one way, Brazil could be going one way, and India could be charting a completely different territory?
Yeah, I think one of the themes in global markets this year has been this uncorrelation, not only between markets, but also between cycles. I think that's the reality. I mean, we had this big synchronization of markets and economies throughout the whole boom and then the bust. Now we're having the after bust, which is every economy has to deal with their own problems, their own cycles. I mean, our central bank is hiking rates. The central bank in India will supposedly will keep easing rates. So it's their own specificities of their own economies and markets, which will drive things going forward.
I could just add a point to that. I think another piece of that is a sign of maturity of some of these markets. For example, if you look at China, what China is trying to do is move away from a model of export-oriented cheap labor to a more sustainable model of steady growth with more balanced economic outcomes for its population, balanced economic outcomes for different sectors. So as it goes through those changes, the markets will be unsure of which way to move. Some sectors will do really well, others won't do so well. So I think it's a sign of not only central banks doing different things in different economies and the post-bust outcome, as Alex mentioned, but also some maturity in the emerging markets. They're becoming more and more emerged as opposed to emerging.
So Glenn, if the script of how 2012 moved was largely dominated by global liquidity in Europe, what will influence the script for 2013 and beyond? Will it be Japan or China?
I think the theme of global liquidity will define the markets certainly this year, possibly next. I think we still have the Fed continuing to pump liquidity into the system, even though there's a little bit of a debate about different members of the Fed wanting to stop sooner rather than later. I think that will continue because the chairman of the Fed and his presumed successor are very focused on what happened in our Great Depression, and they are very focused on continuing that liquidity. I think Japan is producing new momentum in terms of liquidity, and I think the ECB still has some room to go and some arrows in its quiver. So I think liquidity will continue to drive markets. Which markets that liquidity flies to will really depend on the fundamentals of those markets, whether certain structural reforms are taking place, whether corporate earnings are improving, etc., and investors will be looking for those opportunities.
Alexander, how does one change or judge rather that where will liquidity move? What could be the next port of call for global liquidity?
Yeah, I mean, we've been discussing a lot whether the European Central Bank will be the next very aggressive move, maybe next year. We have England, we have United States and Japan, all of them with very aggressive policies. It seems to be that given the economic cycle, the European Central Bank should be the next step. I mean, there could be surprises there probably by late this year or next year. That could be the next step.
And just to sort of maybe add to that a little bit, I think generally speaking what investors try to do is they come into the year and they look at how markets have performed in the previous year and they try to make their reallocations primarily based on which markets have outperformed.
Is that the right way?
And which have underperformed. Well, I would suggest that the right way is probably to look at the fundamentals and to see which markets provide you the best opportunities. What's certainly the wrong way is to look at the best performing markets of the last year and to allocate to those. That momentum could continue in some instances, but generally the ones that have underperformed in prior years tend to outperform in future years. You tend to have this mean reverting concept in investment theory that plays out not necessarily year in and year out, but over periods of time.
So Glenn, where does India fit in? Because if I map the institutional activity, especially flows into Indian equities, last year we got record inflows, and this year so far thankfully we've got more record inflows.
I think India is certainly a very key part of global flows. India, as I said earlier, has captured the imagination of global investors. People want to invest in India and are looking for reasons to invest in India. I think what we saw last year in terms of the flows and flows that are continuing this year have been driven by the initial steps the government has taken to make some reforms. As those steps continue, as that reform continues, liquidity will continue to flow in India. Investors, however, will not be pleased if the reform does not continue. So the liquidity will be fickle. Governments around the world will need to earn that liquidity, but investors are not looking for big moves. They're looking for small signals and looking for validation of those moves. And I think if the Indian government and regulators and central bank delivers on those, I'm sure the liquidity will fly here.
Do you think globally there is a currency war, Glenn? Because that's, again, the next burning topic. If two large central bankers are committed to print money, which is US Fed and BOJ, are we potentially staring at a currency war?
I don't think anyone is really focused on their currencies per se. Really, even in Japan, even though the yen has depreciated recently, the focus really is on stimulating the domestic economy and pulling out all the stops to figure out how we can grow. I think the US is doing the same thing, did the same thing with all the stimulus that you saw in 2009, 2010. The Eurozone will probably do the same thing. And many of the emerging markets as well did the same thing. So I don't think it's a currency war per se. I think there's a global, I wouldn't say coordinated move, but it seems relatively coordinated. At least everyone's on the same page in terms of the approach to stimulating economies. The impact of that, or the outcome of that, maybe an unintended consequence of that, has been some devaluations of currencies. But what I would say is that if everyone's doing the same thing, then we need to talk in terms of relative strength or devaluation. And even today, with the yen going to 100, it's only back to where it was a few years ago. You know, maybe the yen had strengthened too much while other currencies were being devalued as the Fed was the first to pump liquidity in. And now it's just catching up. So it really doesn't seem to me to be a currency war. And in fact, that term wasn't even used in the IMF meetings last week. So that's a sign that I don't think that that's a focus.
Glenn, let's start getting some closing comments now. Last 3 years have been pretty binary for global money managers. Risk on and risk off. Do you think next 3 years would be challenging or next 3 years would be better?
I think it's going to be the same for the next 3 years. I think really what's driving this risk on and risk off trade is liquidity. There is a lot of liquidity in the system, but everyone is nervous. Everyone is nervous because we haven't seen sustainable growth around the world. We're still recovering from the financial crisis. As we all know, it takes a long time to recover from a global financial crisis. So I suspect that this volatility, the risk on, risk off trade is going to continue. The liquidity is going to remain fickle. It will be racing from one asset class to the other, from one country to the other, looking for opportunities because investors ultimately do want to invest and want to seek out opportunities. So I don't think really anything will change over the next few years unless, and let's hope this happens, all the governments begin to make the structural changes that we all know they need to make. I think the probability of all of that occurring in the very short term is relatively low. Some countries will be able to do things, but consistently across the globe, I think we'll have to wait for some more time before we see that happen.
Alexander, what is your big idea for next 3 years, and give me a market or an asset class you are bullish on?
Yeah, we trade mostly Brazilian assets. It's our main core, so we're not a global kind of asset management. We are more into Brazil. So we've been very active in the bond market. Brazilian bonds offer very attractive yields, not only on nominal but also on real side of it. So we think there is huge value on real rates. In Brazil, we trade around 3.5–4%, which you don't get everywhere. And Brazilian equities, despite 3 years of a very struggling market, are trading at, as I told you, a reasonable valuation. So it should be, global investors should allocate some part of their money into Brazilian equities.
What is your big idea?
I'm not sure it's big or not, but I think, as I said, the aggressive monetary easing just started. So we see, pretty abundant liquidity in Japan, and that means the risky assets, domestic risky assets, especially equity and real estate markets, will be the most attractive one for Japan.
Glenn, you are an insurance firm, and you are of the view that the best of the bond market is behind us, which means you need to reallocate your total portfolio. So how are you reallocating, and what is your big idea for next 3 years?
Well, from an insurance point of view, the real focus in managing insurance money is to match your assets and liabilities. So we don't really see the need to reallocate, because ultimately as an insurance company, you have to invest in fixed income. The key, though, is to match those assets and liabilities. So even in Japan, even in the US, we will continue to invest in long-term bonds because our liabilities are very long-term. The only place that we will be thinking about reallocating potentially could be from corporate bonds to other asset classes, but we think it's too early yet to be talking about that. Corporate fundamentals, certainly in the US, are at the best they've ever been in many, many years. We're beginning to see the first signs of some leverage buyouts and some mezzanine financing, but that's just the first sign. This market will continue to run, we think, for a few more years before we need to get worried about the state of credit fundamentals. But that might be the only time we could reallocate a little bit away from credit and into less.
Any thoughts
credit.
on increasing allocation to India? You don't have a big presence in India because...
Well, India would not fit into our portfolio as an insurance company. So it would only fit if clients give us a mandate to invest in India. Within our global debt portfolios or global emerging market equity portfolios, we certainly have an allocation to India.
Are you looking at increasing that?
Since I don't personally run those portfolios, I'm not exactly sure what our portfolio managers are focused on at this time. It seems like India provides the opportunity for a great return both on the fixed income side and on the equity side. So I would hope that our portfolio managers are in fact increasing their allocation.
But given an option to give money to Japan or Brazil, which way are you leaning? Will you give the check to Kenji or will you give the check to Alexander?
The way I would recommend doing it and the way I would advise our portfolio managers is to diversify their bets. We have really no idea which way the market...
just because they are friends.
Of course, we're all friends over here. The money will flow to all markets. The one that delivers on the reforms will be the one that gets more.
On that note, gentlemen, really appreciate your time. Let me thank all of you individually, Glenn, Kenji, Alexander. Really appreciate your time. That's it on this special show of CIO Calculus. I'm Nikunj Dalmia signing off. Thank you for watching the show.